This just went from bad to worse. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we have a shocking new report that shows the global economy is decelerating at a faster rate than we previously thought. And I want you to put this in context, because what do we hear from the political elites, the global central bankers, and the mainstream media is that we're just in a soft patch. We're just in this engineered soft landing by the Fed, and the global economy is strong, and we're going to come roaring out of this. And yet when you see this report, you're going to see that the economy is in far dire shape than any of them want to admit, and this soft landing is likely to be a second quarter recession followed by something much worse. Plus, the U.S. manufacturing sector is starting to point fingers. We're going to look at who they're blaming and why they've got it wrong. And if you thought all these layoffs that just happened were coming to an end, well, brace yourself. The second round is just about to begin. Let's head over to the Wall Street Journal, where we picked today's story up with a headline: Chinese exports pull back again, hampering post-COVID recovery as outbound shipment has suffered a string of declines. And now this should not be happening at all, because global trade is the lifeblood beyond the US dollar, which we'll talk about later in the show, is key in understanding what's going on with the economy. If the second largest country, the world's largest exporter, China, is seeing a pullback in exports, what does that mean for the largest country in the world, the biggest importer? Well, it means there's a demand issue. So when you see this report, it tells you something is quite wrong. Exports from the world's second largest economy fell 6.8% during the first 2 months of 2023 from a year earlier, extending a string of year-over-year declines stretching back to October, according to data from China. Now, if you go back to October, what's interesting here is a year before that, we started to see the end of all the fiscal stimulus. And this is what I think is the real catalyst here of what's going on in the global economy that nobody seems to be paying attention to, is when you withdraw all the stimulus from the global economy. Now, it's still going to filter through. There's still going to be a lagged effect where the money gets spent over time. But at some point when it goes away, everything starts to grind to a halt. And now we're seeing that. The trend is likely to continue as central bankers in the U.S. and other developed economies signal they may keep interest rates higher for longer to battle inflation, which could damper Western demand for Chinese-made furniture, electronics, and other goods. Again, we're blaming, of course, the central bankers. Now, for China, the softening export sector poses uncertainty for the broader economy. No, it poses a massive amount of uncertainty for the economy, because if your business is the second largest exporter and exports are going down, what does that mean for people having jobs? Well, it means that people are going to lose their jobs because they don't need to manufacture as many goods. It's devastating news for the Chinese economy. And of course, that tells us, as we look toward the US and other parts of the world, demand is coming down. And of course, the blame, as we always are going to hear, it's due to the central bankers. But as you see on this next chart, I don't think that's the case at all. Here we have the imports and goods. So this is looking at total imports into the U.S., that includes Chinese imports against the federal funds rate. And what I want you to point out here and want to see is, if indeed the Fed was having an impact here, what you should see is the Fed raises rates. And again, we don't have any more data on imports going back further than this, but what you should see is almost an opposite in terms of a mirrored move. But what you see is the Fed's raising rates, and you still see imports to the U.S. expanding, and then they both come crashing down, with the Fed following a decline in imports as we head into the dot-com bubble. But look at here, you see 2004 was the Fed raising rates. There's no slowdown in the global economy. Even when the Fed pauses, the global trade is expanding, and then it crashes following, again, this is key now, following the Fed pull back. Here you can see the Fed raising rates starting in late 2015 all the way into 2019. No real slowdown in global trade. It's still expanding here. And again, you'll notice the Fed's cutting, followed by then a collapse into the pandemic. And now you see the Fed raising rates. And again, you look at imports and they're moving higher here. So this whole notion that the Fed is to blame, I don't buy into that at all, because again, if that was true, then we should see almost a mirror of those charts, maybe with a lag, but we should see some evidence that the Fed is having an impact here, and they're not. While the global economy appears to be resilient so far this year, it won't reverse the outlook that demand will likely soften and China will experience negative growth in exports this year. According to the chief economist at Morgan Stanley, who predicts falling exports will be a drag on overall growth. And so, yes, the global economy is going to face a problem. I don't know how resilient it is, but the idea that falling exports is a drag on global growth, it is an indication that global growth is slowing. It's not a drag. It is actually the catalyst. It's telling us what is wrong with the global economy. Because if you want to see the global economy expanding, there are two things we should at least see: expanding imports and expanding exports. And when you see those happening together, well, then you know there's lots of demand, there's lots of production, and the global economy should be booming. If you see a contraction in exports, it's a big sign that things are going wrong. And here you can see perhaps the real catalyst not being the federal funds rate at all, but now we have imports against current new orders. This from the Philly Fed. And as we've talked about on the show, new order demand is a highly leading indicator because when people stop ordering things, well, eventually it backflows into the manufacturing. Now, of course, there's backlogs that have to be worked through, but eventually those backlogs are gone and you face a empty amount of new orders, and then the economy slows down. And look at the relationship here between these. What do we see? Current new orders decelerating, and then all of a sudden imports come down. You see new orders starting to decelerate and then contract. Imports come down. You see again, deceleration, imports fall, deceleration, contraction, and imports come down. So you can see exactly what's going on here. And what do we see with new order growth going on right now? It's telling us that imports to the U.S., exports out of China and the rest of the world are about to collapse. And after a nearly 3-year-long run dating back to the early months of 2020, China suffered its first year-over-year drop in exports in October, kicking off a string of declines that has continued at least into February. Again, this wasn't supposed to happen. We were supposed to see a soft landing and a rebound, and China's export data is telling us that's not happening. But again, you go back to October, and you then rewind a year before that, you see that was the tail end of all those stimulus checks. They filtered through the global economy now and is leaving a giant hole that has nothing to fill it. And here we can see again, perhaps go back to yesterday's show where we talked about the dollar. Notably, we see in periods of stress, again, you talk about financial stress, but you also understand that we're not just talking about imports and exports, is the dollar is the lifeblood of the global economy. So as the amount of dollars are expanding in the global economy, it indicates trade's expanding, and it means everything is functioning good. But when you see a shortage of dollars, as we talked about again yesterday, what do you see? The value of the dollar rise, but you should see the global economy contract. And this is simple. As there are fewer dollars to grease the wheels of the global economy, what does the global economy need to do? Contract down. And that's what we see in this next chart here. Notably, see going into, of course, the great financial crisis, the dollar shoots higher, and of course, dollar stress, dollar shortage, and what happens? Imports to the U.S. come crashing down. You can see here the dollar rising, imports slowing down. Here you see the dollar going vertical during the pandemic, imports crashing. Here you see the dollar rallying, and now all of a sudden, imports are starting to slow down, and the dollar's looking to make potentially another move higher. If that's an indication of the dollar shortage, which we won't know for a while, but if it is, it tells us the global economy is just at the beginning phases of a contraction. Chinese imports, meanwhile, fell by a larger than expected 10.2% in January. So far, we've talked about this being an external issue. The global economy is China's problem. No, what we're also seeing is it's an internal issue. Demand inside of China is collapsing. Now, remember, their economy just reopened not too long ago. There was supposed to be a mountain of demand coming out of there, and we're seeing just the opposite. Worse than December's 7.5% year-over-year decline and the 5.1% pullback forecast surveyed by economists, which indicates China's reopening, there you go, hasn't translated into anything. Nothing. It's nada. Zilch. And yet China faces extremely severe challenges on the foreign trade front amid global recession risk, slowing overseas demand growth, and strained global supply chains The data show that China becoming increasingly reliant on trade with its neighbors as demand from the West dries up. And of course, this is that whole Belt and Road initiative by China. They're looking for demand outside the U.S., outside its Western trading partners. And who do you best go to? Your next door neighbor. And so they're desperate because, again, they are the world's manufacturing base. When the global economy slows down, they're going to get hit first. When they go down, it takes everyone else with them. And here we have more evidence this container shipping market yet to bottom as spot rates keep slipping. Again, indication right now that things are getting worse as spot indexes are not plummeting like they were in the second half of last year, but they keep falling week after week. This is proving that transport capacity, as we've talked about, they built a ton of ships during the pandemic because to handle all this demand that was coming continues to exceed demand and is signaling where annual contract rates are heading into 2023. And that is bad news for carriers who are going to be struggling. But more importantly, it gives us an indication of demand. It tells us again, further contracting. Now let's shift and talk about how the U.S. manufacturing sector is getting has a big problem. And of course, everyone's saying it's the Fed. As the Fed's rate move puts manufacturing sector at risk, I don't know if I agree with that at all. New orders for manufactured goods contracted for the sixth straight month through February, according to the ISM. Manufacturing output now down 1.7% from its post-pandemic peak in May of 2022. And the Commerce Department measure of civilian capital equipment orders, excluding aircraft, the building blocks of business, was down 3.4% in January. Of course, everybody's saying this is due to the Fed. As we've shown before, this has nothing to do with the Fed at all. It has to do with the fact that the global economy is slowing down. It has a lack of fiscal stimulus that is now withdrawn, and everything needs to shrink down back to where it should have been. Weaker manufacturing data suggests consumers or businesses are starting to retrench in the face of economic uncertainty or perhaps just collapsing demand. A manufacturing downturn could be a sign of trouble in the broader U.S. economy, and it not only could be, it usually leads the services sector by a matter of months. And although manufacturing accounts for a relatively small share of GDP, or about 11% has historically been an early indicator of a recession. And of course, here we have it again. Do you see how the media blames the Fed? It's the Fed's aggressive pace of interest rate increases to fight inflation that has made it more expensive to borrow big ticket items such as consumer appliances or business machinery. And the reality is, if the economy was booming, do you know what people tend to not care about? When they get a raise or business is good and they see prosperity in their future, they don't go out and worry about price. They don't worry about a little bit higher interest rate. If there's something they want, they go buy it because they're seeing prosperity in their future. And one place we're not seeing that coming now is the labor market. As Metre is planning thousands more cuts after widespread layoffs, here we have that next round is coming as CEO Mark Zuckerberg has previously indicated that the social media networking giant would be concentrating this year on efforts intended to lower the company's costs, pitching 2023 as a year of efficiency. He told analysts in February that Metre is focused on cutting projects that aren't performing or may longer be crucial, and that plans on removing layers of management to make decisions faster, meaning we will need fewer employees to do that. And this is something a lot of businesses are going to start doing as demand falls, something all businesses should do. Whether you're self-employed or you're a big corporation, you should always be looking to improve efficiencies. But right now, with everything contracting, it means more layoffs. More layoffs mean less demand, puts in our economy in face of a massive recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.